Stocks not doing a whole lot today, fluctuating back and forth, but we want to look ahead now to what we can expect in 2010. So joining me now is Craig Peckham. He's equity trading strategist at Jefferies here in New York. And Craig, looking ahead to 2010, you're actually pretty optimistic, it sounds like, judging from the notes that we got on your thoughts. So why so optimistic?
Well, let's be very clear. 2009 is going to be a very hard act to follow here. Any year in which you can generate 20% returns out of the equity market, I would consider to be a pretty good year. Layer that on top of the 60% plus gains off the March lows. That's a pretty good show indeed. I think took a lot of people by surprise. Looking at 2010, I think I have probably a more modest outlook for stocks relative to the returns we saw in 2009. But I do think there's a few areas certainly of outperformance. We'll get into those in a second. But I think the larger overriding theme here that really dictates why we are so constructive in the equity market is really predicated on two basic principles. Number one, we still have a very highly accommodative monetary policy backdrop, not just in the U.S. but globally, which we think bodes well for top-line improvement, which is something we really haven't seen yet out of corporate America. I think secondly, we've got to pay very close attention to the fact that this has been a market which, while it's had extraordinary gains off the lows, is one that has not seen really very broad-based participation. We've seen consistently negative outflows from equity mutual funds for as far back as really anybody can remember. I think that probably changes in 2010 here as more money gets pulled in off of the sidelines. That sort of double-barreled liquidity dynamic for 2010 is pretty important.
Craig, I want to get to the monetary policy question first. Isn't, though, one of the issues that even though you have this easy monetary policy, that credit is still relatively tight, and then that has constrained growth to some extent? What convinces you that that's going to change?
Well, I think there's largely a bit of a game of chicken and egg here. Clearly, there's a lot of liquidity available in the form of cheap cost of funds. The problem has been that, at least if you look at the banking sector, it's not translating into very much loan growth. In part, that's because we've had a real shock to the system over the last 2 years, where, particularly in the consumer sector, there hasn't been a great propensity to borrow. I think as economic conditions firm, as employment improves, we'll probably see the pendulum switch back to the other way and start to see some increased loan velocity out there, which ultimately is going to translate into more credit. We're not going to get back to the extremely leveraged levels that we saw in 2007, but I would expect to see a more measured recovery in terms of appetite for credit.
And Craig, what about the economic backdrop here and how it relates to stocks? Because yes, we have gotten some encouraging economic data, but then for every positive point you have, then you have a negative one, like today's housing numbers, for example. Yeah,
I mean, it would be very easy if we had a recovery that was built in a straight line form up and to the right, but I think that's too much to expect in any kind of economic recovery. Expect this to be fitful. I would sort of be very pleased to see the economic data stream, bat 750, with, if you will, with us getting 3 positives for every 1 negative. And I'd expect that to continue for some time here.
Craig, what about this record-wide yield curve that we're seeing between 2 and 10-year spreads? Is the market pricing in a recovery?
I think that's absolutely what that means. Typically, the bond market does a very good job in terms of setting the slope of its yield curve as predictive of what we're going to see from a recovery standpoint. The other dynamic at play here as well is a bit of a supply and demand dynamic with regard to Treasury issuance that we haven't seen before. We know we've got massive amounts of Treasury issuance. It's skewed towards the back end of the curve. I think that's putting some upward pressure on the far end of the curve as well.
Right.
Meantime, you've got Fed policymakers really doing all they can to suppress the short end of the yield curve. Expect this steepness to continue, I think, for the better part of 2010.
The better part, do you mean at least third quarter of 2010? Is it going to go on that long?
Yeah, I think that to the extent that short rates are going to be dictated by changes in Fed monetary policy, I think it's a safe bet that we're going to be in the third quarter before anything changes meaningfully.